Have you ever wondered how to spot a bear market? Understanding this concept is crucial whether you're a seasoned investor or just getting your feet wet in the world of finance. So sit back and relax as we unravel this mystery in a simple step-by-step manner. First off, what is a bear market? It's a condition in which securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Typically, bear markets are marked by a general sense of dread and anticipation of further declines in asset prices. Now, how to spot one? The first step is to understand market trends. A bear market doesn't occur overnight. It's often preceded by a market correction, a short-term trend that has a duration of less than 2 months. Look for a drop of at least 10% in the S&P 500, Dow Jones Industrial Average, or other benchmark indexes. The second step is to monitor economic indicators. These include unemployment rates, GDP, retail sales, and consumer confidence indexes. An increase in unemployment rates, a decline in GDP, weak retail sales, and low consumer confidence are often signs of an impending bear market. Next, keep an eye on market volatility. The volatility index, also known as the VIX, measures the market's expectation of 30-day forward-looking volatility. When the VIX is high, it means that investors expect significant changes in the market, which could signal a bear market. The fourth step is to watch the yield curve. If the yield curve inverts, meaning long-term interest rates fall below short-term interest rates, it could be a sign of a bear market. An inverted yield curve has preceded every US recession since the 1950s, though it's not a guarantee. Lastly, pay attention to investor sentiment. When investors start to panic and sell off their investments, it can lead to a bear market. A shift from optimism to widespread pessimism among investors can often signal the start of a bear market. So, to recap, spotting a bear market involves understanding market trends, monitoring economic indicators, keeping an eye on market volatility, watching the yield curve, and paying attention to investor sentiment. Remember, spotting a bear market is more of an art than a science, and it involves a good deal of observation, patience, and analysis. But why is this important? Because recognizing a bear market can help you make informed decisions about your investments. Whether you decide to sell, hold, or perhaps even buy more depends on your personal investment strategy, risk tolerance, and financial goals. Remember, even in a bear market, there are opportunities. It's all about staying informed, remaining patient, and making strategic decisions. So keep these steps in mind, stay vigilant, and as always, happy investing.